Okay, so if you've ever stared at a stock chart and felt like you were trying to decode some sort of alien language made of red and green lines, trust me, you are not alone. Welcome to This Explainer. Today, we're going to absolutely demystify the intimidating world of technical analysis, and we'll transform those chaotic lines into a clear, totally readable story of human behavior.
Now, this brings up a really fascinating question. How did an ancient method literally become the backbone of modern Wall Street? You know, way before computers or trading algorithms were a thing, 17th century Japanese rice traders needed a way to track price movements. But more importantly, they needed to track the emotion driving those prices. They figured out that the psychological reaction to a price change is just as critical as the actual number itself.
And when these ancient Japanese techniques finally made their way to the Western world, traders realized something pretty incredible. They weren't just looking at a dry math formula. They were looking at a highly logical footprint of human psychology. It's basically a psychoanalytic lens into the market's endless battle between the bulls and the bears.
Fast forward to today, and those same ancient principles have evolved into the modern cheat sheet we all use. By the time we wrap up here, you're going to be able to look at these recognized patterns and see exactly what the buyers and sellers are doing in real time, so you can actually anticipate what the market might do next.
So here is our roadmap for today. 1. The anatomy of a candlestick. 2. The story in the shadows. 3. Powerful patterns to know. 4. The secret of volume analysis. And 5. Decoding market psychology.
All right, Section 1. The anatomy of a candlestick. Building the baseline vocabulary.
Let's zoom right in on the absolute smallest unit of a chart. Every single candle compresses hours or even days of market drama into just 4 data points: the open, close, high, and low. I want you to think of that thick middle section, the real body, as a literal battlefield. A bullish body, which is usually green or white, means the bulls won the round. The asset closed higher than it opened, showing a ton of enthusiastic upward momentum. On the flip side, a bearish body, usually red or black, reveals overwhelming selling pressure. The asset closed lower than it opened, meaning the bears controlled the action. And the actual size of that body, that tells you the intensity of the conviction.
Okay, so to truly grasp what a candle is saying, you decode it sequentially using these 4 simple steps. First up, look at the color to see who's currently in charge. Second, measure the body. A wide body means a strong, aggressive move, while a super thin one means indecision. Third, inspect those wicks to gauge the volatility. And finally, compare where the price opened and closed versus its extreme highs and lows. That gives you the full context of the battle.
Moving right along to Section 2, the story in the shadows, decoding market rejections.
So, if the body of the candle is the main plot of our story, the wicks, well, they're the subtext. And these shadows speak volumes. An upper wick shows that buyers pushed the price high, but just couldn't hold it, which points directly to resistance. A lower wick shows that sellers pushed the price down, but buyers stepped right in to rescue it, strongly suggesting support.
And the size of these wicks absolutely matters. A long wick, that's basically a failed ambush by one side. It shows extreme volatility and tells us that smart money might be stepping in to completely reverse the trend. Short wicks, on the other hand, well, they tell us the market is calmly accumulating. You've got consistent buying or selling pressure without all those wild, crazy fluctuations.
All right, Section 3, powerful patterns to know, reading the group dynamic.
When you zoom out and put a few candles together, you start to spot these high-probability psychological setups. First is the Doji. It has this tiny little body and long wicks. It's essentially a tug-of-war that resulted in a draw, signaling massive market indecision. Next up is the hammer. You'll see a small body at the top with a super long lower wick, representing a heroic rescue mission by buyers after heavy selling. Then we have the shooting star. It's the exact opposite of a hammer, indicating that sellers aggressively regained control after buyers tried to push the price up.
Now, sometimes one side completely and totally overwhelms the other. If you see a small red candle just get swallowed up by a massive green candle, that's your bullish engulfing pattern. And it screams institutional buying. It signifies a total shift in sentiment from bearish to bullish.
Oh, and here's a really fascinating one, the Marubozu. This candle shows such extreme conviction that there is zero pushback. Literally, no wicks exist. It opens at the absolute low and closes at the absolute high, or vice versa. It is a striking visual representation of total, undisputed domination by either the buyers or the sellers for that entire block of time.
Let's jump to Section 4,
The secret of volume analysis, the ultimate context layer.
Here's the thing. Candlesticks alone don't tell us the true strength behind a move. We absolutely must look at volume. If candlesticks are the words, volume is the tone. I mean, if you see a massive bullish engulfing candle on low volume, it's just a whisper. Smart money isn't really involved. But if that exact same candle appears with a massive spike in volume, now it's a shout. That right there is a high accuracy prediction signal.
Think of this matrix as your cheat sheet for volume. Rising price with rising volume, you're looking at a strong trend. High volume actually confirms a breakout. But a rising price with falling volume, that is a massive warning sign. The trend is getting weak, and you are seriously at risk of a reversal or walking right into a trap. Volume is the key that separates true market moves from false breakouts.
And finally, Section 5, Decoding Market Psychology, the battlefield revealed.
Bringing all of this together, we have to remember we aren't just analyzing math here. We are analyzing human behavior. And because of that, charts are about probability, for sure, not certainty. You must never look at a single candlestick in total isolation. A hammer pattern floating around in the middle of nowhere means very little. But a hammer pattern sitting perfectly on a historical support level, backed by a massive volume spike, now that is a high probability trade.
Thank you so much for joining this explainer. I'm going to leave you with this final thought. Technical analysis isn't some magic crystal ball. It's a mirror. It reflects collective human behavior. And yeah, that includes your own biases. So you really have to ask yourself, are you reading the market's mind or just your own?